Hey everybody, so welcome to our latest round of updates with our fund managers from Hong Kong. So my name is Jonathan Wu. I'm the head of distribution as well as the chief investment specialist for Premium China Funds Management. And today we're having a direct Zoom call with Frank Tsui, who's one of the senior fund managers at Value Partners. So Frank's has over 17 years of industry experience, as well as spending the last 5 years with Value Partners in the capacity of going from fund manager and now to becoming a senior fund manager. So Frank, great to have you on the call today.
Hey everyone, thank you, Jonathan.
So just to, I guess, as a starting question, Frank, I mean, you're based in Hong Kong and obviously, you know, each country has taken different approaches to lockdowns and quarantines and whatnot. I mean, how's the feeling on the ground in Hong Kong at the moment around, you know, the containment on the spread of COVID-19? And I mean, are you guys generally scared to go out, meeting people and things like that?
Well, I mean, it's April right now, and if you look back and see the number of new cases in Hong Kong, I think Hong Kong has done a good job to contain the virus. So we have been recording, single-digit number of new cases in the last couple of days of time. I think overall speaking, people are generally all relieved, just looking at the number. But in terms of like people going out on the street, sentiment-wise, it's still pretty much like last month that people are still staying at home, and I think people are still very highly cautious about the virus situations and try to prevent the second wave or the possible outbreak. So that's why people still been pretty much like quite cautious in the meantime.
So it's I guess it's quite quiet. I guess I mean people aren't really eating out. People aren't shopping, and so I guess just like most economies of the world at the moment, it's very, very quiet.
Yeah. Well, I mean, obviously, the last few weeks' time, it has proven that social distancing actually works from stopping the virus to spread over. So I think people are still pretty much staying at home.
Yeah, no, that's good. I mean, seeing through what's happened with focusing on the economy first and seeing how it's had such this widespread impact on the way that sort of we live our lives and whatnot. I mean, most people are currently turning towards China to sort of see, China being sort of the first into this crisis and then being the first out. And I guess as an extension to that, you have places like South Korea or Taiwan that's also shown quite successful ways of containing COVID-19. I mean, do you see metrics at the moment from what you see, on the ground in Hong Kong and also with your colleagues in China, that first in, first out, and China can really sort of, continue to grow the way it has been coming out of this crisis?
Well, yeah, I think that's a good question. As I said, now it's April, and that still gives a pretty reasonable amount of time to look back on how China or Hong Kong, Taiwan, or Singapore has gone. China as a developing country, how they responded to the outbreak of COVID-19 versus the developed countries is just, very obvious. I think to contain COVID-19 quite a quick and strict lockdown, late reaction and response to pay a much higher cost. And obviously China has showcased, the kind of strict lockdown, and that has been giving them a shorter recovery time. And the work resumption in China is still happening and is still on track. And going back to your questions about China's being first in, first out, I wouldn't completely say China is totally immune from a potential wave of virus outbreak, because that will still depend on the virus situations. But obviously we're seeing a shorter recovery time. And China, it looks to me, the domestic consumption, the domestic work resumption, everything is still, heading to the right direction. So, say 1 or 2 months' time, it would pretty much be resuming 90% of the resumption rate, which I think is pretty constructive when you're looking at, resuming the growth of China. So that, that's how I view it at the moment.
Okay, so from that, taking it, directly to, the portfolio that you guys are managing, I mean, how has it impacted, through sort of last, quarter, or, sort of getting into 4 months now? I mean, how has it changed the positioning of the portfolio, and sort of, how does that blend in with, the strength of the team and the company business that you guys undertake?
Sure. I think first of all, our investment team people are still pretty much solid. We still have like 70 people doing on the ground work. Despite not being able to travel around, we're still conducting a lot of like company research. And I think due to the country lockdowns, we faced a simultaneous global demand and supply shock. And therefore, our reaction to the event was quite swift to assess the COVID-19 impact to the company we invest. So I think, overall speaking, when we look at the macro data, it's very likely to continue to be under pressure, but it does not necessarily mean all companies suffer from the same scale of damage. Just looking from that perspective, I think our conclusion or our views, in the last 3 months, is that we tend to like to stick with companies that are domestically driven, as they are less exposed to the global demand drag, and should also benefit from the domestic work resumption. This is the first thing. Companies with less correlation with the macro economy would be, an area that we think might, give some like outperformance in the near term. And obviously, we prefer online, over offline to benefit from the quarantine policies and the change of consumption behavior of late. So these are, some of the findings and, some of the studies that we had conducted in the last 3 months' time, and that actually has been given a pretty, constructive and solid foundations to our portfolio positionings.
I mean, with the just sort of breaking down into that online theme. I mean, even locally, we've seen, given everyone's in quarantine, people are staying at home, working from home. We're ordering, the equivalent of Uber Eats and things like that, and also, people that want to keep shopping are obviously going online and going on eBay and whatnot. I mean, are you guys also seeing that sort of trend play out? Because I mean, last year when you were last in Australia with us in September for the roadshow season, we talked about Alibaba and Tencent and all these online names. I mean, has the thesis of investing in these companies, have they fundamentally changed?
Well, yeah, I think, thanks for bringing that up. Last year, I was just, throughout, the roadshows I've been mentioning about the online, the e-commerce, and also the online content provider. And I think they have benefited, more than ever, during this kind of event. Obviously, I think the consumption pattern has obviously changed because of the quarantine policies, that people are, buying things online, especially for like consumption staples, like those essential goods. I think at the beginning there was a bit of a obstacle because of the riders, the delivery, the last mile delivery on physical goods were a little bit of under some challenging conditions, because the riders are not being able to drive their bike to deliver goods at the very beginning. But slowly after, it's actually very things are going back to normal like pretty swiftly. And I think when you look at Alibaba or maybe some other e-commerce names, the share price actually has rebounded quite obviously, as people are actually turning more positive because of such change of consumption behavior. And I think not only the e-commerce, but the people selling services online, and also people that are providing online contents, like all these companies are still looking pretty solid, from that perspective. So I totally agree with you on that. The virus event, has given a very, I would say, an unprecedented change of people's consumption behavior, despite, when things are back to normal, that people will be going back on the street to spend money. I think it's that first experience, for some of them, to buy things online, to subscribe, online contents. The first time experience is extremely crucial for these online players to eventually monetize their user base over the long run. So I think that is actually pretty constructive from that perspective.
So, I mean, we hear a lot, sort of carrying on with that theme. I mean, we see a lot of fund managers that have been talking about, okay, markets have sort of corrected, reasonably severely, sort of, since the Fed decided to basically throw, what we refer to as kitchen sink infinity at the market and effectively buying everything, which is sort of, to a certain extent, that could be against, your traditional rules of capitalism and letting the market find price discovery. But, in across Asia, markets haven't corrected as deeply, obviously for a number of reasons. So in this environment, I mean, what sort of sectors are you seeing that are there particular sectors which, you've been monitoring where it has become increasingly attractive because of this crisis, whether because the sector has had further, depressed valuations or, further uncertainty or transparency around future earnings? I mean, are there those pockets of opportunity at the moment?
Yeah, sure. I think based on what I've just mentioned about, the conclusion of, the COVID-19 environment, that we stick with companies that are domestically driven, companies with less correlation with the macro economy, online over offline. That actually has been driving a bit of our focus to the areas that we have been, looking at, and also, the holdings that we have been having in our portfolio, such as like domestic consumer names, both staples and very selectively in some discretionary names, such as, companies that sells food and beverages. And also in healthcare sectors and education sectors, these sectors would tend to be, less correlated with the macro economy. And also e-commerce, technology, hardware, these names, will actually benefit, from the online consumption as mentioned earlier. Coming back to your questions about, there are some depressed valuation sectors. I think these are more of like a traditional, kind of like value sectors. But however, I think, some of these sectors such as banks, materials, utilities, I think we're actually trying to, see, or trying to avoid this kind of sector, because these are more linked to the macro environment and might likely to see, more downgrade pressures from the streets or, by the consensus, throughout 2020. So I think it actually comes down to a very critical or crucial moments that, you're, being selective and not overly overwhelmed by, the low valuations from, some of the traditional, low PE sectors. I think we're still, looking for, companies that will be, supported by the resumption of the economic activities, and that is still showcasing, strong secular growth. And I think investors should still be, focusing on these areas.
So we saw a video that you guys released interviewing the chairman and the co-chief investment officer, Dato Chia, and one of the things that he spoke about was the strength of China overall, and that if you look at debt levels and things like that, China is in a far better position than most other countries, right, in terms of having to print money and throw a lot more stimulus behind it, dependent on how well the country had contained the virus in the first place. And across Asia, you sort of see a similar sort of theme where, because of what happened in 97, 98 with the Asian financial crisis, a lot of corporate mindset has led them to have lower levels of leverage on their balance sheet. which which has led them to not have to be in a desperate environment where they're raising fresh capital at really depressed share prices and things like that. I mean, is this this pandemic event, which no one had predicted, which is a black swan event, well, the pure definition of a black swan event. I mean, have you seen that Asian companies weather this better by having the reserves on hand to sort of, ride the storm out however long it may take?
Yeah, well, I think this is a very good observation, but I think this doesn't happen in just like a short span of time. As you mentioned, I think since the last decade, a lot of the Asian companies, especially companies in Greater China, they're actually seeing a much better financial status by having a much stronger balance sheets. And this kind of factor stands out much more during an event like this. I think overall speaking, as an equity investor, people would always look at the earnings strength, how much upside they could get from this revenue level, or from the net profit level, or even on the net margin level. But during this kind of event, I think this is the time when revenue or profit are less of a concern, and it's more on the safety represented by the strength of the company's balance sheets, because this gives you, the indications on how it could sustain the operations of the business and how a company is geared and not overly leveraged to avoid liquidity problems. So I think I agree with you, and also our CIO views about company having much stronger foundations from a balance sheet perspective. I think these companies tend to get through this kind of event easier than others who might face substantial financial issues. So I think if we just take a step back and look at emerging markets versus developed markets, or just particularly Chinese companies versus US or Europe companies, you can easily find companies in Asia or maybe China that are actually having a lower gearing ratio. They have higher net cash level, and overall speaking, they should be facing less liquidity or cash flow issues during this kind of crisis, and they should be able to recover faster as well.
I mean, speaking of just the amount of research that we're doing, through the investment team of over 70, and the 6,500 company visits. I mean, we have seen a few sort of traditional international equity managers currently talking about how they're trying to get into China, or they have started to make investments into China. And something that I'm sort of reminding investors out there at the moment is that you do need on-the-ground research for this, and that's why these sort of Frank talks with Frank is very important to sort of get a grasp of what's happening right here, right now, because markets have changed dramatically in a short period of sort of 6 to 7 weeks. So on that, Frank, thanks very much for spending some time with us today, and keep safe, and keep doing the great work that you guys do.
Thank you, Jonathan, and you too. Take care.
Thank you.